Hi, I'm Roger Montgomery from Montgomery Investment Management, and welcome to this week's Video Insight. As you know, it's been our view for some time that the dynamite waiting to go off in the Australian economy is the residential construction industry. And at the start of the year, we highlighted the fuse, the substantial collapse of circa 40% in residential building approvals. Of course, approvals are a perfect leading indicator for construction activity, and our channel checks have all confirmed what we suspected. Developers, particularly house and land package developers, are facing a cliff in activity. In fact, some New South Wales developers have told me that their pipeline will be down 50% by Christmas. Now let's consider that for a moment. The construction industry is 9.6% of the Australian workforce, and it's the third largest employer. Of that, 37% is residential construction. In other words, 3.5% of the Australian workforce is facing a drop in activity of as much as 50%. That has to impact their incomes at best and jobs at worst. One anecdote we have channel checked is the plight of bricklayers. Last year, bricklayers were in short supply, and if a builder could find a brickie, they were demanding $1.80 per brick. Earlier in the year, we discovered bricklayers were becoming plentiful and offering to lay bricks for $1.30 a brick. And most recently, we've heard of examples where bricklayers are offering to lay at close to $1 a brick. As I mentioned, the drop in activity will impact incomes, even for those that still have work on. And that's got to impact retailers. On that front, and going into reporting season, we've maintained the view that retailers will report reasonable numbers for FY19. And that's because construction activity has still been strong, as homes that were ordered a year or two ago are still under construction. But once those homes are complete, the picture for retailers could deteriorate rapidly. Indeed, while JB Hi-Fi has reported a 3.5% rise in revenue and a 7.1% increase in net profit for 2019, gross margins were down. And unsurprisingly, while the good guys posted like-for-like sales growth of 0.9% for the year, for the last quarter of the year, they were actually down 0.7%. And for July, like-for-like sales are down 3.4%. It's the first month of the new financial year, and we think things will get tougher. We remain of the view that retailing gets harder before it gets better. Now, about green shoots. If green shoots are going to emerge, it has to happen now. The Libs winning the federal election, an uptick in the housing market, which has been reflected, I guess, in rising loan applications and higher auction clearance rates, and that's thanks to rate cuts and better access to capital, as well as the Libs tax cuts, and all of those are key factors and are all steps in the right direction. But what's needed is the purchase of new, not established dwellings. A larger number of people have also filed their tax returns early this year to collect the rebate. But that's small change, and nobody will know for a few weeks if that money will be spent at the shops or used to reduce debt. Between now and Christmas, retailers could benefit from the Black Friday and Cyber Monday sales and Christmas itself. But I maintain that what is needed is the purchase of new houses and apartments, lest the post-Christmas dip is deeper than we have seen for some years. At a private lunch I attended on Monday with the Reserve Bank of Australia, my concerns were confirmed. The high-rise construction sector is troubling, and the extent to which stimulus helps recharge the residential construction industry will determine whether an economic fuse is lit. For investors, we currently hold the view that value will emerge amid downgrades in businesses exposed to the domestic residential building and retail sectors. To be clear, Australia is not currently at risk of a recession. Regional infrastructure activity, large stimulus to China's domestic economy to offset the weakness in the trade-warring external economy, and low rates for the foreseeable future should ensure the aggregate economy does okay. But that doesn't mean individual sectors can't suffer their own individual periods of negative growth. And that's where value investing might offer value. That's all we have time for this week. Please follow us on Facebook and Twitter.